Something is happening in the US bond market right now that most everyday investors are not paying close enough attention to. And if history is any guide, ignoring this signal could turn out to be a very costly mistake. A market that is supposed to be the safest, most stable corner of the entire global financial system is flashing warning signs. Treasury yields are surging, demand at government auctions is weakening, and the very behavior of bonds has reversed in a way that has not been seen in decades. Today, we are going to break all of this down. What is happening, why it matters, to what it could mean for your understanding of gold, silver, and the broader economy going forward. Stay with us because by the end of this video, you are going to see the financial system in a way you probably never have before. Welcome back to Microintelligence Hub. If you are here for the first time, this is the channel where we cover global markets, macroeconomics, and precious metals trends in a way that is clear, analytical, and grounded in what is actually happening. Not hype, not fear, just honest analysis of the facts as we understand them today. Today, the facts are genuinely worth your full attention. Before we go any further, I want to be clear about something important. Nothing in this video is financial advice. We are not telling you to buy or sell anything. This is purely educational and informational content meant to help you understand some of the most significant dynamics unfolding in global markets right now. To always consult a qualified financial professional before making any investment decisions. With that said, let us get into it. Now, most people think about stocks when they think about investing. Stocks are exciting, they move fast, they make headlines, they show up in every news alert on your phone. Everybody has an opinion on the stock market. But here's what most people do not realize. The bond market is actually far larger than the stock market. The global bond market is worth somewhere in the range of $130 trillion. The US stock market, large as it is, does not come close to that number. And the reason bonds matter so much is not just because of their size, it is because of the role they play in setting the price of money itself. US Treasury bonds are the foundation of the entire global financial system. When the US government needs money to pay its bills, to fund its programs, to service its already enormous pile of existing debt, it borrows that money by selling bonds to investors. And investors from all over the world, from pension funds in Tokyo to central banks in London to regular American retirement accounts in Canada, have historically bought those bonds because they are considered the safest investment on the planet. Behind every single one of those bonds is the full faith and credit of the United States government, the most powerful economic and military force in the history of the modern world. The promise has always been enough. Until recently, there was never a serious question about whether the United States would pay its debts. It always has, and the world has always believed it always will. Now here is the critical relationship you need to burn into your memory if you want to understand everything else we talk about today. Bond prices and bond yields move in opposite directions. Think of it like a seesaw. When investors want to buy bonds, when demand is high, the price of those bonds goes up, and the yield, which is the effective interest rate you earn from holding the bond, goes down. But when investors do not want bonds, when demand is weak, or when people are actively selling bonds, prices fall and yields rise. The yield is essentially the interest rate the government must pay to convince people to lend it money. When confidence is high, yields are low. When confidence is shaky, yields rise because investors demand more return to compensate for the perceived risk. So when yields rise sharply, that is not just a number on a financial screen that only traders care about. It means the cost of borrowing money is rising across the entire economy. For the government, yes, but also for banks, for mortgage holders, for corporations trying to expand, for small businesses trying to survive. Every corner of the economy is connected to what happens in the Treasury market. It is why it matters so profoundly. That is why what is happening right now should be on every informed person's radar. So let us talk about the current situation in specific, concrete terms to 10-year Treasury yield, which is the single most important benchmark interest rate in the world, the one that directly influences mortgage rates, corporate borrowing costs, and the valuation of virtually every asset class on Earth has surged to around 4.36% as of this week. The 30-year yield has climbed to nearly 4.88%. And the 2-year yield is sitting above 4% as well. For context, a few years ago, these same yields were close to zero. The United States was borrowing money at essentially no cost. The era is definitively over, and the transition has been painful, disorderly, and not yet finished. Now, what is driving this latest move higher in yields? There are several layers here, and they are all feeding off each other in a way that makes this moment particularly complex for investors and policymakers alike. The first and most immediate layer is the geopolitical situation. The ongoing conflict in the Middle East involving Iran has sent oil prices sharply higher. Crude oil has surged well past $100 per barrel. Think about what that means for the everyday economy. Higher oil prices mean higher gasoline prices for every American filling up their car. They mean higher shipping costs for every product that moves across the country. They mean higher electricity bills, higher manufacturing costs, higher airline tickets. Energy is the lifeblood of a modern economy. And when the price of energy spikes like this, inflation, the rate at which prices across the whole economy rise, gets a powerful new injection of fuel. And when inflation rises, bond investors demand higher yields to compensate for the fact that by the time their bond matures, the money they get back will be worth less in real purchasing power terms. So inflation fears and rising yields go hand in hand. That is the classic mechanism, and it is very much in operation right now. But here's what makes this particular moment genuinely unusual and frankly alarming for experienced market watchers. Historically, and we mean going back decades, when there's a major geopolitical crisis, investors have rushed into U.S. Treasury bonds as a safe haven. Prices rise, yields fall. It happened after the September 11th attacks. It happened during the 2008 financial crisis. It happened during the COVID crash of 2020. Every time the world got scary, money flooded into U.S. Treasuries because they were considered the single safest place to park capital on Earth. War was supposed to be good for bond prices. Crisis was supposed to send yields lower. That relationship is now broken down. In the current environment, bonds are being sold during a crisis, not bought. Yields are rising, not falling. The market is behaving in a way that defies decades of established pattern. And when the financial system stops behaving the way it has always behaved, that is a sign that something deeper and more structural has changed. Wall Street is noticing, and it is right to be alarmed. To really understand why this breakdown is happening, we have to go a full layer deeper than the geopolitics. There's a structural story underneath all of this that has been quietly building for years, and the current crisis is simply shining a bright light on cracks that were already there. The United States is carrying an enormous and still growing debt burden, nearly $38 trillion in total national debt. To put that in perspective, that is more than the entire annual economic output of the United States, the European Union, and Japan combined. And this debt is not shrinking. The federal government is running annual deficits that add hundreds of billions of dollars to that total every single year. There is no realistic political path in sight toward balancing the budget. Both parties spend heavily when they hold power. They simply disagree on where to direct the spending. The trajectory of U.S. debt is, by any honest assessment, unsustainable over a long enough time horizon. Here is why that matters for the bond market right now in a very immediate and practical way. Every year, the U.S. Treasury has to borrow new money, not just to cover the current year's deficit, but also to refinance old debt that is coming due. The old bonds mature, the government has to pay back the people who hold them, and to do that, it must sell new bonds. This year alone, it is estimated that roughly $10 trillion of U.S. debt needs to be rolled over. $10 trillion. There's an absolutely staggering amount of new bond supply being introduced into the market in a single year. When supply of anything goes up and demand does not keep pace, the price falls. For bonds, that means yields go up. The sheer mechanical weight of U.S. Treasury supply is one of the most powerful upward forces on yields right now, independent of everything else happening in the world. Here is the other side of that equation, the demand side, which is where things get really interesting and somewhat unsettling. For decades, the United States benefited enormously from what economists call the exorbitant privilege of issuing the world's reserve currency. Because the U.S. dollar is used in the majority of global trade and held in the reserves of virtually every central bank on the planet, there has always been a structural, never-ending demand for U.S. Treasury bonds from foreign governments and institutions. That demand was a subsidy, in effect. It allowed the U.S. to borrow cheaply and run large deficits without the kind of market discipline that would normally force a correction. Foreign central banks, particularly China and Japan, were among the largest holders of U.S. Treasuries. They bought them year after year as a way of managing their own currencies, recycling their trade surpluses, and maintaining reserves in the safest possible asset. Reliable foreign demand is now fraying. China has been quietly but consistently reducing its holdings of U.S. Treasuries over the past several years as its relationship with the United States has grown more adversarial. Japan, dealing with its own complex economic situation, has become less predictable as a buyer. Countries across the Middle East, which historically recycled petrodollar revenues into U.S. bonds, are diversifying more aggressively. And in the current geopolitical climate, with trade tensions, tariff disputes, and the weaponization of the dollar-based financial system as a foreign policy tool, more and more countries are thinking seriously about reducing their dependence on U.S. Treasuries. When you strip away that reliable baseline of foreign demand, you expose a supply-demand imbalance in the Treasury market that pushes yields structurally higher. We have seen this dynamic show up directly in the data in a very visible way. Recent Treasury auctions, the formal process through which the government sells new bonds to institutional investors, have drawn what multiple analysts described as disappointingly weak demand. At some of these auctions, yields had to come in higher than the market had expected just to attract enough buyers to absorb all the supply. That is like a store that expects to sell out of a product, having to cut the price to move inventory. In the bond market, the price cut is a higher yield, meaning the government has to promise to pay more interest in order to find enough buyers. The dynamic, playing out repeatedly in real time at Treasury auctions, is one of the most concrete and measurable warning signals in markets right now. There's one more concept worth introducing here because it is coming up more and more in the language that serious market analysts are using, and it is central to understanding what the bond market is trying to say. It is called the term premium. In the simplest possible terms, return premium is the extra yield that investors demand for the risk of locking their money into a long-term bond, say a 10-year or 30-year Treasury, rather than simply rolling over short-term bonds repeatedly. When investors have a high degree of confidence in the future, in the stability of inflation, in the soundness of government finances, in the predictability of monetary policy, they accept a relatively low-term premium because they are not particularly worried about what the next 10 or 30 years might bring. But when uncertainty rises, when the fiscal picture looks unstable, when geopolitical risks are elevated, the term premium rises too. Investors essentially say we need to be paid more to take on this uncertainty. The term premium embedded in U.S. Treasury yields is rising right now. That is the bond market pricing in a future that looks less certain, less stable, and more expensive than it once did. And when the most sophisticated investors on Earth are doing that calculation and arriving at that conclusion, it is worth listening to. Now, the Federal Reserve sits right at the center of all of this, and its situation right now is genuinely one of the most difficult any modern central bank has faced. The Fed controls short-term interest rates, the federal funds rate, which it uses as its primary lever to manage inflation and support economic growth. After the inflation surge of the post-pandemic years, the Fed raised rates aggressively, bringing the federal funds rate to its highest level in decades. Then, as inflation appeared to be cooling through 2024 and into 2025, the Fed began carefully lowering rates, 3 cuts in 2025, with markets expecting another 1 or 2 in 2026. The narrative heading into this year was one of gradual normalization, inflation coming down, rates coming down, the economy landing softly. That narrative has now been thrown into serious question. The energy shock from the Middle East conflict has injected fresh inflationary pressure into an economy that had not fully finished its battle with the last round of inflation. The Fed now faces a situation where it cannot comfortably cut rates. Doing so might add fuel to an already reigniting inflation problem, but it also cannot raise rates without risking genuine damage to an economy that is already feeling the strain of elevated borrowing costs. Some corners of the market are actually beginning to price in rate hikes, not cuts, later this year. That is a stunning reversal from where expectations stood just a few months ago. The yield curve, the relationship between short-term and long-term interest rates, tells this story visually. When the yield curve is normal, longer-term bonds yield more than shorter-term ones. When it inverts, when short-term rates rise above long-term ones, it has historically been one of the most reliable predictors of a coming recession. We spent a significant portion of the past few years in that inverted territory. Now the inversion has resolved, but not in a reassuring way. We are entering what analysts call a bear steepening, a situation where long-term yields are rising faster than short-term ones. This pattern signals that investors are not just worried about near-term economic weakness. They are worried about the longer-term fiscal and inflationary picture in a more fundamental way. A bear steepening means mortgage rates stay painfully high, which means corporate borrowing stays expensive. It means economic headwinds are sustained, not temporary. And it means the government's own interest payments on its massive debt pile keep growing, crowding out money that could otherwise be spent on productive investments in infrastructure, education, or healthcare. Now let us bring precious metals into this picture, because this is where things get particularly fascinating, and for a lot of viewers of this channel, personally relevant. Gold had one of the most extraordinary bull runs in modern financial history over the past year and a half or so. From early 2025 through late January 2026, gold nearly doubled in price, eventually hitting an all-time high of over $5,500 per ounce. Silver's performance was even more dramatic. It rose by approximately 270% over roughly 12 months. These were absolutely historic moves by any measure, driven by a confluence of factors that we have covered extensively on this channel: central bank buying, dollar weakness, geopolitical uncertainty, inflation fears, and a broader growing skepticism about the long-term soundness of government finances globally. Then came a sharp and painful correction. Gold pulled back to around $4,000 at its worst point, and silver fell even harder, to at one point suffering its worst single trading day since 1980. And the question that a lot of our viewers understandably asked was this: if the world is in chaos, if debt is ballooning, if geopolitical risk is elevated, and inflation is resurfacing, why on earth would gold sell off? Gold is supposed to be the safe haven. Gold is supposed to go up when things get scary. What happened? The answer is an important lesson in how markets actually behave under extreme stress, as opposed to how we might theoretically expect them to behave. When volatility spikes sharply and fear becomes overwhelming in the financial system, institutional investors, the big players, the hedge funds, the leveraged traders, do not always run toward safe havens. Instead, they run toward liquidity. They need cash, and they need it fast. And the fastest way to raise cash when everything is falling is to sell whatever you can sell most easily. Gold and silver, being among the most liquid assets in the world, become targets for that forced selling, not because investors no longer believe in them as stores of value, but simply because the positions are large, they are profitable after a massive run-up, and they can be liquidated quickly to meet margin calls or cover losses elsewhere. The precious metals sell-off we witnessed was not driven by a change in the fundamental argument for owning gold. It was driven by a mechanical, technical unwinding of overcrowded leveraged positions. When you understand that, the correction makes sense. And more importantly, it does not negate the underlying story. The more nuanced and genuinely complex question for gold and silver going forward is the relationship between yields and precious metals prices. This is the tension at the heart of the current market environment. When Treasury yields are high, when a 10-year U.S. government bond is paying 4.5% interest with the full faith and credit of the U.S. government behind it, there is an obvious question for any investor. Why would I hold gold, which pays no interest and no dividend, when I can collect a reliable 4.5% yield just by lending money to the U.S. government? Logic is the so-called opportunity cost argument against gold, and it is a real, legitimate argument that has historically had meaningful influence on gold prices. Rising real yields adjusted for inflation, tend to be headwinds for gold. The dynamic is in play right now, and it cannot be dismissed. There is a powerful counter-argument that many of the world's leading financial institutions are making with increasing conviction. The structural forces driving gold higher are not dependent on short-term yield levels. Central banks around the world, particularly in China, India, Russia, and a wide range of emerging markets, have been dramatically accelerating their purchases of gold over the past several years. This is not a marginal shift. It is a fundamental change in how a significant portion of the world's monetary authorities are thinking about reserves. They are diversifying away from the US dollar, away from US Treasuries, and toward gold. And the reason behind that shift connects directly to everything we have been discussing today: the unsustainable US debt trajectory, the politicization of the dollar-based financial system, and a deepening uncertainty about the long-term purchasing power of paper currencies issued by deficit-spending governments. One strategist framed it this way: gold is the only major asset in the world without counterparty risk. Every other financial asset, a stock, a bond, a bank deposit, depends on someone else's promise to pay. A stock is only worth something if the company performs. A bond is only worth something if the government or corporation behind it honors its obligations. Even a bank deposit depends on the solvency of the bank. Gold does not depend on anyone's promise. It has been a store of value for thousands of years, and in a world where trust in paper promises is being tested, that quality matters in a way that transcends yield comparisons. The long-term structural bull case for gold, anchored in central bank accumulation, dollar skepticism, and the mathematics of government debt, remains intact. Most major institutions covering precious metals, including J.P. Morgan and Goldman Sachs, maintain their bullish long-term forecasts for gold even through the correction, with targets ranging from $5,000 to over $6,000 per ounce by the end of 2026. Silver tells a somewhat different story than gold, and it is worth separating the two. Silver has both a monetary dimension, like gold. It is held as a store of value and a hedge against currency debasement, and a very significant industrial dimension. Silver is a critical component in solar panels, electric vehicles, semiconductors, and a wide range of modern technologies. Structural demand from the global clean energy transition alone has created a long-term industrial demand story for silver that is genuinely compelling. However, silver's dual nature also makes it more volatile than gold. When industrial demand softens, silver suffers more than gold. When financial markets get stressed and investors dump liquid assets, silver tends to fall harder and faster. That is exactly what we saw in the recent correction. Silver's long-term story is interesting, but comes with significantly more volatility and requires more tolerance for short-term pain. So let us step back now and look at the complete picture from the highest possible vantage point. What you're witnessing in global markets right now is not a routine fluctuation. It is the surface expression of several deep structural forces that have been quietly building for years, and they are now colliding simultaneously in a way that is creating genuine complexity and genuine risk for investors, policymakers, and ordinary people whose mortgages, retirement accounts, and economic futures are connected to these markets whether they realize it or not. You have a realize it or not. This fiscal situation that is genuinely unsustainable over any reasonable long-term horizon, with debt levels rising faster than the economy can grow and annual deficits showing no credible political path toward resolution. Do you have a geopolitical environment where energy prices are surging and inflation, which central banks spent years and enormous credibility fighting to bring under control, threatening to reaccelerate? You have a Federal Reserve caught in one of the most difficult positions any central bank has faced in recent decades, with the dual mandate of fighting inflation, supporting growth, pulling in opposite directions simultaneously. You have foreign buyers of U.S. Treasuries becoming less reliable as the geopolitical fragmentation of the global economy accelerates. You have a bond market that, for the first time in a very long time, is no longer behaving as the automatic, reflexive safe haven it was always assumed to be. These are not isolated stories. They are threads in the same fabric. The breakdown of the bond-to-safe haven dynamic, the bear steepening of the yield curve, the weak Treasury auction demand, the rising term premium, the energy shock feeding inflation, Fed on hold, all of these things are connected expressions of the same underlying shift. is a gradual, still unfolding erosion of the unconditional confidence that the global financial system has historically placed in the U.S. Treasury market as the bedrock of everything. Whether that erosion leads to a serious dislocation or is gradually managed through policy adjustments and market adaptation, nobody can say with certainty. Markets are resilient, and history has many examples of seemingly dire structural problems being resolved more smoothly than anyone expected. The signals are real, and they deserve serious, sustained attention. What should you concretely be watching going forward? Keep a close eye on Treasury auction results. Those are like a regular public report card on how much confidence the global investor community has in U.S. government finances. When auctions are weak, when yields have to come in higher than expected to attract buyers, it is a real-time warning signal that should not be buried in financial news footnotes. To watch the 10-year Treasury yield specifically, if it moves meaningfully and sustainably above 4.5% or approaches 5%, that would be a significant tightening of financial conditions that ripples across mortgages, equities, corporate debt, and economic growth. To oil prices, because energy is the single most important wild card in the inflation story right now. And oil's direction will have enormous influence on whether the Federal Reserve feels it can cut rates or is forced to hold or even hike. And watch gold, not just the day-to-day price, which will always be noisy, but the medium-term directional trend. If gold manages to regain its footing and resume moving higher even while Treasury yields remain elevated, it will be one of the most powerful signals possible that sophisticated investors are beginning to fundamentally question the real long-term value of the U.S. dollar itself. That is not a signal to ignore. Here is the key takeaway from everything we covered today. The U.S. bond market, the bedrock upon which the entire architecture of global finance rests, is sending a warning. Rising yields, weakening auction demand, a breakdown in the traditional safe haven behavior of treasuries, a rising term premium in the structural weight of trillions of dollars in debt refinancing, all of these point to a market that is demanding more compensation for the risk of holding U.S. government debt. And when the bond market speaks with that kind of clarity, the rest of the financial world eventually has no choice but to listen. The ripple effects touch everything. Mortgages, stocks, corporate borrowing, the value of the dollar, and the price of gold and silver. We are not here to tell you that a crisis is inevitable or that catastrophe is around the corner. What we're here to tell you is that these are important structural signals that anyone who takes their financial literacy seriously should understand and monitor with care. The bond market is often called the smartest market in the world, because it tends to identify and price an economic reality before the stock market, before the news media, and before policymakers catch up. Right now, the bond market is speaking loudly. It is worth asking yourself whether you are listening. As always, everything you have heard today is purely educational and informational in nature. None of this constitutes financial advice of any kind. Do your own research, consult with a qualified financial advisor, and make decisions that are appropriate for your own individual circumstances, your own risk tolerance, and your own long-term goals. If you found this analysis valuable, please take a moment to hit the like button. It is a small action that makes a real difference in helping this channel reach more people who are trying to make sense of what is happening in these markets. Drop a comment below and tell us what you are thinking. Are you watching the bond market closely? Are rising yields changing how you think about your portfolio? Do you still believe in gold and silver as long-term stores of value despite the recent volatility? Do read every single comment, and we genuinely value your perspective as part of this community. And if you want to stay ahead of the curve as this story continues to develop, because this is absolutely going to continue developing, make sure you hit the subscribe button and turn on notifications so you never miss our next analysis. Here at Microintelligence Hub, we are committed to bringing you the clearest, most grounded market intelligence we can, week after week. Thank you for watching. Stay informed, stay patient, and we will see you in the next one. This video is for educational and informational purposes only. It does not constitute financial, investment, or legal advice. Always consult a qualified financial advisor before making any investment decisions.